Now, I want to go over 5 more examples on how to calculate the loan amount. So we're going to flip over the equation, and it's simply a matter of going over some of these examples so that you better understand how to do this. So let's do an exercise now on, let's say the situation is that Carla's monthly interest payment on her HELOC is $180. If the current interest rate is 6% per year, you're going to calculate the original amount that the borrower owed. So in this case, for Carla, we're going to use the equation. Principal equals monthly interest times 12 divided by the annual interest rate. And that's going to be $180 times 12 divided by 6%, or 0.06, which will equal $36,000. So the original loan amount was $36,000, and that's how you calculate it. Now, these examples are very important. I know it's a lot of mortgage math, but it won't take very long. We're going to focus now on adjusting for a rate change, okay? So the situation is basically this. Following a rate adjustment on your HELOC, your monthly interest payment increased from $250 to $300. If the rate adjustment was an increase from 5% to 6%, calculate the original loan amount before the rate change. So the solution is going to be basically like this. We have to use the equation or the way to factor in what that amount is going to be. So we're going to use monthly interest divided by new rate times old rate. So we're going to do this. We're going to take 300, which is the monthly interest, divide that by 12 times 0.05, which would be the 5%, then we're going to get 25,000. So the original loan amount before the rate change was 25,000. And if you didn't understand, it's perfectly fine. You can go back and do it again. So let's move on to the next exercise. So for problem number 3 on loan amount repayment, I want you to calculate the payment structure for this deal. So let's say Samantha has a total monthly payment of $500, which includes both principal and interest, okay? And the interest portion is $150 at an interest rate of 4.5%. I want you to determine how much the borrower initially borrowed. Now, I didn't ask you to pause any of the videos before, but right now I want you to go ahead and pause this video, and I want you to do this calculation. I'll just give you a hint. You're going to use this equation. You're going to use monthly interest, how much they pay in interest, times 12 divided by the interest rate, okay? I want you to do that right now. Pause the video, do it, and then come back. All right, let's get started. So if we take our monthly mortgage interest payment, which is $150, and we multiply it times 12 and divide it by 4.5%, which would also be 0.045, we would get a total loan amount of $40,000. So the original loan amount was $40,000 for Samantha. Let's go over exercise number 4 in calculating loan amounts. So in this case, we're going to use the cumulative payments calculation. So let's say after paying a total of $24,000 over 4 years towards your HELOC, of which $6,000 was interest, and the interest rate was 3%, I want you to find out or figure out how much you initially borrowed. Now, this is a trickier question, so I'm going to help you out on this one, okay? We're going to take the equation. Principal paid equals total payments minus the total interest. So in this case, the principal paid is $24,000. We're going to subtract $6,000, and we're going to get $18,000. So that is exactly how much was paid over the last 4 years, okay? Now we have to calculate the principal from that interest. So we're going to go ahead and use the equation annual interest divided by interest rate, which is going to be 6,000 divided by 4, which will equal 0.03, and then that's going to equal $50,000. So the original loan amount is $50,000. So let's go over that one more time. So we figured out the principal payment by subtracting the $24,000 minus the $6,000 that was paid in principal, and we got $18,000 as the amount that was owed. And then we're going to take or calculate the principal from the interest by taking the 6,000 divided by 4 years and then dividing that by 0.03, and we're going to get $50,000. Now let's do one more exercise, which would be number 5 for calculating the loan amount, and would be a total of 10 math problems that we've done right now, specific for mortgage calculation on home equity lines of credit. So this is the exercise. We're going to reverse engineer payments. How are we going to do that? Let's see this example. So knowing that your monthly payment is designed to only cover the interest, and that your monthly interest rate is 0.25%, resulting in a payment of $125, determine the original loan amount. So how are we going to calculate this? We're going to take the principal. We're going to use the equation principal equals monthly interest divided by monthly interest rate. So we're going to use the calculation $125 divided by 0.0025 divided by 50,000. Now, what would be the solution to this problem? So let's go over the equation first. Principal equals monthly interest divided by monthly interest rate. So the calculation is as follows: $125 divided by 0.0025, and that's going to equal $50,000. So the original loan amount is $50,000.